uncertainty surrounding the leadership of our nation. Doubts, fears, and panic often lead to bad decision-making and even worse policy. I urge you to reject outside political pressure in this volatile time and stay the course for the good of the American people and our economy as a whole. Thank you for your service, and I yield back. I'll now recognize the ranking member of the full committee, Ms. Waters.
Thank you very much, Mr. Chairman. Welcome back to the Honorable Jerome H. Powell, Chairman, Board of Governors of the Federal Reserve System. Chair Powell, as we saw with the latest jobs report, the labor market remains strong and the economy is surging. Despite inheriting an economy from the prior administration that had the worst jobs record since the Great Depression, President Biden has now overseen a record 15.7 million jobs created since he took office, with 206,000 new jobs created just last month. Not only that, but under the Biden administration, we're witnessing low unemployment rates, rising wages, and stabilizing prices for goods and services. This is not only because of President Biden's strong leadership, but also because of the historic legislation signed into law by President Biden, which has resulted in lower costs, created more jobs, rebuilt our infrastructure, supported small businesses, eliminated mostly junk fees, wiped out more than $144 billion in federal student loan debt for 14 million borrowers, and cut child poverty in half. President Biden is and will continue to advance policies that are providing good-paying jobs and an economy that works for everyone. Now, while I'm pleased to see that inflation is declining, the latest data makes clear that housing remains the #1 driver of core inflation. Since 2020, house prices have increased by nearly 50%.
What's going on? What's going on, guys?
Now spending on
How you feeling? How you feeling?
Over 30% of their income on housing. This is a top priority for Democrats, but remains an afterthought for Republicans. Earlier this Congress, I reintroduced my comprehensive legislation housing package, including the Housing Crisis Response Act. This bill provides more than $150
Let me know how you guys are feeling.
In fair and affordable
I am watching this
housing
news release, ladies and gentlemen.
representing the single
First things
largest
first on the
investment
day.
in affordable housing
I do want to let you
in our
guys know
nation's history.
at 10
These
a.m.
funds would create
Fed
nearly
Chair
1.4
Powell
million
does
affordable
testify
and accessible homes,
in front
bring down housing
of the
costs
House
for all,
right now.
and
This is going
revive
on
the
right now.
American dream
He's being
of home
questioned.
ownership. Committee Democrats
And
are
this is a
committed to
testify
getting this bill
right
across
now
the
where
finish line, and
if it's
continue
more
to hold out
hawkish,
hope
it would be
that our
expected good for the
Republican colleagues
currency.
will finally
I do
join
see
us
the
in
dollar
this
actually
effort.
slowly dropping, so I actually would like
Extreme MAGA
the dollar
Republicans
to
are not
continue
just
dropping
ignoring housing inflation.
if
They're
this news
advancing
release
their
continues
Project
to
2025 manifesto
actually do its
that would
thing. Honestly, I want you guys to
dismantle
watch
US
this live
democracy and
with
the
me in
economy
real
as we
time.
know it today.
I'm over here on the
Project
charts,
2025
looking at stuff
is authored by
and looking at
almost 2
gold.
dozen former Trump White House staffers and Trump administration officials. It was compiled and published by the ultra-far-right Heritage Foundation, whose CEO recently declared that they are, quote, in the process of a second American revolution, which will be bloodless if the left allows it to be, quote, unquote. And if that kind of talk reminds anyone of the rhetoric we heard in the lead up to and on January 6, 2020, it should. Project 2025 promotes radical ideas to materially
Where you guys tuning in from? Let me know in the chat.
Reserve, if
Let me
not
turn this up.
effectively abolished. MAGA wants to put you out of a job, Chairman Powell. So I look forward to your testimony and hearing from you, a Republican who was first nominated by President Trump, about your thoughts on the importance of the Federal Reserve and the work you have done to help our economy. And I yield back.
Let's listen up.
Generally yields back. I note for the records, Jerome Powell was initially nominated by President Obama to the Board of Governors of the Federal Reserve before being nominated by President Trump to chair. So here we are. We'll recognize the chair of the Financial Institutions Subcommittee, Mr. Barr, the Andy Barr variety, for 1 minute.
Thank you, Mr. Chairman. Welcome, Chairman Powell. Runaway inflation and increased interest rates necessary to confront it continue to hammer Americans, and especially those living paycheck to paycheck. Workers and families feel the pain, making everyday purchases at high prices in the grocery aisles and at the pump. They have suffered years of eroding purchasing power in their paychecks under the Biden administration's economic mismanagement. Heightened mortgage rates make it prohibitive for new home buyers to reach the American dream of a starter home for their family. I am pleased that the Fed is resolute in getting inflation under control. I am pleased that you have committed to an apolitical approach to this. I am not pleased by the Fed's opaque, unjustified, politicized, and underanalyzed regulatory proposals, which will ultimately hurt all Americans. We need to know where the Fed is going on its fundamental.
Little Rock. Shout out to Little Rock in the building. Shout out to Marcus, my brother. Appreciate it.
Well,
Appreciate
Chair
you
now
for
recognizes
staying
the,
tapped in.
Ranking member of the Financial Institutions and Monetary Policy Subcommittee, Mr. Foster, for 1 minute.
Thank you, Chair McHenry and Ranking Member Waters. I'd like to also thank you, Chair Powell, for joining us today and for the role you have played in combating inflation and supporting a stable economic recovery. While the presidency is often the focus of political pronouncements about macroeconomic conditions, there's no question that that undersells the importance and the independence of the work of the Federal Reserve Board. While actions taken by the President and Congress certainly play a significant role, monetary policy decisions made by an independent Federal Reserve are the big dog in shaping macroeconomic conditions that shape economic outcomes for millions of Americans. And work continues on inflation, but significant progress has been made to bring the country in line with the Fed's 2% target. The good news is that macroeconomic policy is working as designed. Well-calibrated monetary policy with fiscal support from the American Rescue Plan, the Infrastructure and Jobs Act, and the CHIPS and Science Act has powered strong job creation and low unemployment while staving off a recession that many thought inevitable, and far better, I should point out, than our peer countries. While Democrats are committed to supporting your efforts to cut costs for American families, I yield back.
We'll now welcome the testimony of Jerome Powell, the 16th chair of the Federal Reserve Board of Governors. Chair Powell, you'll be recognized for 5 minutes to give an oral presentation or testimony. Without objection, your written statement will be made a part of the record. You're now recognized for 5 minutes.
Chairman McHenry, Ranking Member Waters, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. The Federal Reserve remains squarely focused on our dual mandate to promote maximum employment and stable prices for the benefit of the American people. Over the past 2 years, the economy has made considerable progress toward the Federal Reserve's 2% inflation goal, and labor market conditions have cooled while remaining strong. Reflecting these developments, the risks to achieving our employment and inflation goals are coming into better balance. I will review the current economic situation before turning to monetary policy. Recent indicators suggest that the U.S. economy continues to expand at a solid pace. Gross domestic product growth appears to have moderated in the first half of this year, following impressive strength in the second half of last year. Private domestic demand remains robust, however, with slower but still solid increases in consumer spending. We've also seen moderate growth in capital spending and a pickup in residential investment so far this year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, a broad set of indicators suggests that conditions have returned to about where they stood on the eve of the pandemic, strong but not overheated. The unemployment rate has moved higher, but was still at a low level of 4.1% in June. Payroll job gains averaged 222,000 jobs per month in the first half of the year. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in labor force participation among individuals aged 25 to 54 and a strong pace of immigration. As a result, the jobs-to-workers gap is well down from its peak and now stands just a bit above its 2019 level. Nominal wage growth has eased over the past year. The strong labor market has helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased notably over the past couple of years, but remains above the committee's longer-run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in May. Core PCE prices, which exclude the volatile food and energy categories, also increased 2.6%. After a lack of progress toward our 2% inflation objective in the early part of this year, the most recent monthly readings have shown modest further progress. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee has maintained the target range for the federal funds rate at 5.25% to 5.5% since last July, after having tightened the stance of monetary policy significantly over the previous year and a half. We've also continued to reduce our securities holdings. At our May meeting, we decided to slow the pace of balance sheet runoff starting in June, consistent with the plans released previously. Our restrictive monetary policy stance is helping to bring demand and supply into better balance and to put downward pressure on inflation. The committee has stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. Incoming data for the first quarter of this year did not support such greater confidence. The most recent inflation readings, however, have shown some modest further progress, and more good data would strengthen our confidence that inflation is moving sustainably toward 2%. We continue to make decisions meeting by meeting. We know that reducing policy restraint too soon or too much could stall or even reverse the progress that we've seen on inflation. At the same time, in light of the progress made both in lowering inflation and in cooling the labor market over the past 2 years, elevated inflation is not the only risk we face. Reducing policy restraint too late or too little could unduly weaken economic activity and employment.
I do believe the dollar will actually
Considering
continue going
adjustments to the target
bearish
range for the federal
from
funds
here.
rate, the committee will continue its
As you
focus
guys can see,
on
we have a
carefully
little
assessing
London
incoming data and their
continuation
implications for the evolving outlook,
pattern playing out.
balance of risks,
We will
and
have
the
to see
appropriate
how
path
it
of monetary
reacts once we
policy.
break these lows
Congress has entrusted
and
the Fed
how
with the
well
operational
it
independence that is
continues.
needed to take a longer-term perspective in the pursuit of our dual mandate of maximum employment.
If
and
we
price
break this
stability.
low
We remain committed
and
to
start
bringing inflation
reacting
back
towards
down
the
to our
upside,
2%
then
goal
I will have
and to
to
keeping longer-term
kind of
inflation
change my bias
expectations
here.
well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on those goals matters to all Americans.
So let's see
I'll
how we
conclude by
react
emphasizing that we understand
once we break
that our
these
actions
lows.
affect communities, families, and businesses across the country. Everything we do is in service to our public mission. Thank you. I look forward to your questions.
Well, thank you, Chair Powell. I'll now recognize myself for 5 minutes. Chair Powell, let's begin with this question of the Basel III endgame. I know you got questions about it yesterday, but I think we need further clarity. Your testimony about Vice Chair Barr's discussions with the FDIC and with the OCC on the next steps for the Basel III endgame. You mentioned potential changes have been made to the original Basel III endgame, that a lot of progress has been made, and that the board is very close to agreeing on the substance of those changes. But the next steps, that's really what I want to get into. Let's get through the mechanics of what happens next. If the Fed, the OCC, and the FDIC agree on the substance of whatever changes you're going to make, what happens then? Like, walk through the mechanics as you anticipated. Okay.
So we're very close to having exactly that agreement on the substance of the proposed changes pursuant to those talks. The next question then is how to proceed. And, it is my view and the strong view of a number of board members that the appropriate thing to do is to take that new proposal and publish it along with the effects of the quantitative impact survey and put that out for comment again and receive comment on that and then take some time to review those comments before finalizing the regulation. And that's a discussion we're having with the other two agencies now. We have not been able to reach agreement on a path to do that, but that's something that we're we think is the right way to do. That's what we've done in similar situations. There aren't that many similar situations, but when we see broad and material changes to an important regulation, we think let's go out again and give all the commenters another chance to comment.
Yeah, and that also avoids serious lawsuit risk and the risk that Congress step in
Guys,
and overturn this rulemaking using the Congressional Review Act. I think the other agencies here, if they're not agreeing with the Fed, they're running against
This guy is
independence
grilling
of
him.
the Federal Reserve here. This is not a trifling matter of policy. This is a matter of real substance for the independence of the Fed and rulemaking at the Federal Reserve, which I think we should be able to keep keep the independence of the Fed separate, especially in this political environment. But opening up to a new comment period, so that means you have to get consensus for the Board of Governors on the policy. You have to get the agreement of the scandal-plagued chair of the FDIC or the 5-member board of the FDIC. You have to get agreement by the acting comptroller of the currency. These people should not have real standing with the Fed on a matter of serious policy, especially with a chair of the FDIC that is being ousted by his own party as soon as they can get a replacement confirmed. It's an absurd thing that the Fed has to go to an acting comptroller of the currency and a guy who's going to be out of a job very soon at the FDIC and get agreement. But thank you for listening. That was more of to convey this. So the quantitative impact analysis, is this going to include the interplay with the stress tests, GSIB surcharge, all the other capital charges here? Will that be a part of the quantitative impact analysis?
It'll be this proposal, which does include changes to the GSIB surcharge, but does not include the stress tests.
Okay. But the goal here with the quantitative impact is to actually measure the impact of these rules as enacted, right? Based upon what is existing regulatory structures. Okay.
That's right.
All right, so let's get into the question of balance sheet as quickly as we can. 2.5 years ago, you stated, quote, the committee intends to slow and then stop the decline in the size of the balance sheet when reserve balances are somewhat above the level it judges to be consistent with ample reserves. That's 2.5 years ago. Where are we in this question of what are ample reserves?
Well, so the balance sheet, the runoff in the portfolio is now, I think, $1.7 trillion so far. So we've made quite a lot of progress. We think we have a good ways to go, and as I mentioned, and as you just mentioned, we've now slowed the pace, really with a view to getting as far as we can without creating frictions and disruption that might cause us to prematurely stop shrinking. Going a little bit slower might actually enable us to go further. We think we have quite a ways to go. It's very hard to be precise about it. It's really a question of supply and demand, and we'll find that level with a little bit of a buffer on top of it, and that's where we'll stop.
All right, thank you for your testimony. The ranking member, Ms. Waters, recognized for 5 minutes.
Thank you very much. Chairman Powell, are you familiar with Project 2025?
Not really, no.
You've heard about it?
I really don't focus on these things at all.
You don't focus, but you know there's something known as a Project 2025? The reason I'm asking you is because one proposal is to get rid of the Fed's dual mandate to promote only stable prices, but also maximum employment. This is your mandate. These are mandates, right? This is what you do. Is that right?
We do serve a dual mandate, that's right.
And so if there was anything that would get rid of the mandate, what would it do to our economy? What would it do to our country?
So the question of which mandate we serve is very much a question for Congress. My own view has been that the dual mandate has served us well. This is something Congress can change and change back to a single mandate.
What do you do to get maximum employment? What do you do?
Well, we have one tool on the economy, and that is we raise and lower interest rates. You'll find, though, that anyway, we certainly at the Fed do believe that the dual mandate has been a good thing, and it's enabled us to. It has not stopped us from controlling inflation when that was the thing that needed to be done.
And so while, of course, I understand you may not have seen, heard, or read Project 2025, are you familiar with a effort in the country
Guys, gold is
to get
dropping
rid of
down towards
diversity
the
and
entry.
inclusion?
So if you're looking for an entry here on gold,
I see these things mentioned, but honestly, we're pretty focused on our task, which is maximum employment, price stability. We're strong
coming up.
supporters of diversity at the Fed, as you know.
Are you aware that I created a subcommittee on diversity and employment in this committee?
Yes, I remember that.
And do you think that getting rid of diversity and inclusion interferes with your ability to really realize the mandate of maximum employment?
I spent most of my career in the private sector, and what I observed was really successful institutions in the United States, companies, organizations generally, are those that do a really good job on diversity and get the best out of people and attract a broad, diverse range of talents to the table, and people feel comfortable speaking. So that's the way we feel about it at the Fed, and that's what we've been doing.
I got my alert set right here.
And do you think it's important not only
I will look
to have
for
diversity
entries
and
around
inclusion
here.
in the public sector, but in the private sector also?
Yes, and as I mentioned, if you look at very successful American companies, you will very often see that they're good at that. They're good at hiring, attracting, investing in, and keeping diverse talent. That's one of the things that our really good U.S. public companies do well.
Have you seen improvement during your tenure where diversity and inclusion has created opportunities for more jobs and helped to reduce the unemployment rate?
Certainly seen, I think you see over the course of my long career, a big change in diversity and inclusion. And you see that in the private sector and the public sector, and I think that's generally progress. I do.
Under the work of this committee, and the subcommittee is chaired by Ms. Beatty, she was able to gather important data about what was going on in the private sector. And what she discovered was that many of the CEOs and others welcomed the opportunity to learn more and to do better and to get assistance. And we saw improvement with diversity and inclusion. Have you seen that?
There's no question. If you talk to CEOs, they get this. If you want to attract the best talent in our country now, you need to be committed to these things.
And so I would like to compliment you on the job that you have been doing. I'd like to compliment you on keeping us informed about inflation. Not only do I welcome you here today, I look forward to working with you for years to come. I yield back. Thank you.
Thank you.
Gentleman from Arkansas,
That was
the Vice Chair of
good.
the full committee, Mr. Hill, is now recognized for 5
That was
minutes.
good.
Thank the Chair. Chair Powell, thanks so much and welcome back to the committee. I want to pick up where Senator Tim Scott and Chair McHenry left off and reiterate my strong support for your comment yesterday in the Senate about the need to repropose the Basel III endgame. The Supreme Court's precedent, I think, makes clear that if a rule undergoes broad and material changes from the proposal to final rule, the public must be given a meaningful opportunity to review and comment on those changes. You generally share that view, I think. Is that right?
Yes.
And I'm looking forward to seeing the results of the quantitative impact study and the separate comment period, as well as an interagency agreement you referenced yesterday. Because of Dodd-Frank's role and the Vice Chair for Supervision, Vice Chairman Barr's role and the Fed's role, would it be fair to say the Fed is a first among equals on proposing a rule like this? In other words, does the Fed have a supremacy position on determining whether it should be fully reproposed or not, or do you view it strictly as a collaborative basis? Just curious in your view on that.
I would say it's strictly collaborative, and I would say that our discussions with the FDIC, which Vice Chair Barr has actually been conducting, and the OCC, they've been very productive so far. So I want to make sure to say that we've continued to work our way through this, and I believe we will get fairly soon to a resolution of the remaining process issue.
Good. Well, let me turn from that subject to the court's recent decision to overturn the so-called Chevron doctrine. Many of us believe this was the first step to reining in decades, literally, of the unprecedented, uncontrolled growth in the administrative state. And so I think all of us on at least this side of the aisle are certainly saying to the Federal Reserve and other federal agencies in our jurisdiction that we want to reassert Article I authority over the direction that independent agencies work. Would it be fair to ask you to certify that because of this change in Chevron that the Fed would commit to promulgating new rules only if they're at the direction of an explicit congressional authorization?
So I think, first of all, we're studying that and several other decisions that have just come down in the last week or two, so I haven't got anything definitive for you on that. I think you know us to be an organization, I know us to be an organization that is strongly committed to the rule of law. Supreme Court says what the law is. We'll always do what we believe the law is.
Well, I'll submit that question maybe in more detail in writing, and maybe you'll have a chance to reflect on that. Back in February, you were on 60 Minutes, and you said the U.S. budget deficit, the national debt are unsustainable. Do you still view that the U.S. is on an unsustainable fiscal path?
I do. I think I tried to be clear that the level of the U.S. debt is not itself unsustainable, but the path that we're on is unsustainable, and I think that is not controversial.
I think many of us certainly agree with that, and we know that when the deficit's at 3 times the economic growth rate and growing, it's of concern, and it's contributed to inflation. Just 3 years ago in Jackson Hole, Wyoming, you gave a speech where you were confident that inflation was transitory, which I think we've come to realize that's not the case. This hearing is sort of a can't-miss opportunity for the Fed to demonstrate some humility on the monetary policy decisions, which some on this side of the aisle particularly think have made inflation worse. Your August 2020 Jackson Hole speech, you said the flexible average inflation targeting framework regarding 2%, that you would let it run above 2%. Was the Fed blinded by the previous 20 years of global change that was deflationary and or you were not alert enough in 2020 to be more cautious about that change in policy?
That's crazy, family. What do you guys think? What do you guys think about this speech right now?
Very low interest rates, but also very low inflation, suggesting that the neutral interest rate must have fallen quite substantially. That was the standard view. The thing we didn't see coming was the pandemic. It's not like everything went off the rails. It's like we had this pandemic, and it really changed the way the economy is working. We had a big crisis. We did a lot of things. So the concerns that led us to, those concerns that we were in a world of very low interest rates all the time.
But now wouldn't you say we're in a very opposite situation where because of reshoring and tariffs and other policies that are quite inflationary?
I would say this. Those concerns are, right now we have the policy rate in the mid-5s, right? And we see the policy as restrictive,
likewise,
but clearly
bro.
Interest rates, the neutral interest
I haven't
rate
really
must have
seen
moved
too
up,
much volatility,
at least in the short term.
come in.
So I think that's the question we'll be asking ourselves in our review, which begins at the end of this year.
We look forward to that.
How much of what we did
I look forward to
in
seeing
that time period is relevant
I
to
look
the new
forward to
world where
seeing
rates appear to be higher.
news become
The gentleman from Georgia, Mr. Scott, is
that
recognized
drop
for 5
down
minutes.
to our entry.
Thank
like
you,
you're saying.
Chairman,
Yeah,
and
maybe
welcome,
something
Chair Powell.
goes on.
It's great seeing you.
And we get an
Last time I
excuse
saw you,
to get our entry.
we had the gracious pleasure
How you feeling,
of
my
you
bro?
visiting with
Everything
me
going
in
good,
my
bro?
office, and we discussed a great variety of things. Thank you for that visit. Now, Chair Powell, this year the Fed tested 31 banks, up from
Took any
23
trades at all?
last year. Is that correct?
I believe that's right, yes.
And by
here,
estimating losses,
south.
revenues, expenses,
All right.
and capital level under hypothetical stress scenarios, we did that, correct?
Yes.
I'm glad to hear,
And
bro.
all 31 banks remained above their minimum common equity tier 1 capital requirements after observing losses of nearly $685 billion.
Let's see
Is
if
that
some
correct?
volatility comes in
That is
now.
correct.
Yeah, I wanted to get those figures out.
Oh,
and
this is interesting.
provide you with, you may have heard this.
We did just
but
get
I
a
wanna
spike
share
up
it with
here
the nation
on
because
the
your
DXY.
vice chair, Barr, made
Let's
this
see
statement.
how this wants
and
to play.
I wanted to put this in the record.
On the 4-hour
His
chart
exact quote
and on the
from this
daily.
great achievement. He said, "Our goal of our stress test
It's not a
is to
bad
help ensure
level.
that we have enough capital to absorb losses in a highly stressful scenario." And this test shows that we do. I thought that was a great statement of your record. Now, let me ask you my question. It's simple. Will the 2024 Fed stress test results have an impact on how prudential regulators roll out a new and updated capital proposal?
So the two are really two different things. There's the Basel III capital proposal, and then there's the stress tests. So, and really the Basel III, as I mentioned and we've discussed, we're almost ready to put forward for further comment a revised proposal with material and broad changes to it. The stress
Oil
tests
looks
are a
pretty
different thing, and
bullish
of course, we
as
try
well.
to, we
One
realize
thing
we
that
have to
I'm going to drop in
adapt
the
those
Discord
over
now
time and be open to changes.
is
And
oil.
it has evolved significantly over time, but it's really a separate thing from the Basel III endgame.
Give us a little bit more information on the Basel III, because I worked with you with this. Our work goes all the way back to the Obama
As you guys can see in the
administration
trade
when
alert
we
section
responded to
of the
that
premium,
crisis,
I will be dropping
with our
my
banks. And
charts,
you
trade
and I
ideas,
worked that
any
up where
updates
we came
that
up
I want
with
you
the
guys to
hardest
be
hit
aware of.
program to
So
help
these are some of the pairs I was
those
looking at this
who
morning.
were suffering with those
We
states
were looking
that
at
were suffering
Great Britain pound
with
for the
high
buy.
unemployment
It didn't quite
and at the
retest
same time high home
back down,
foreclosures, and we were
but
successful.
it actually went ahead.
And we've established
still
that
went up.
program, and it's still going on and helping many of our states. But, you know, I want to also share what is happening around the world as a result of our activities. The European Union is now set to delay key parts of its bank capital rules by more than a year, so that their lenders will not be at a disadvantage. Over in Canada,
So yeah,
it's
we were
important
looking
to
at
know
gold
that
buys.
their banking regulators have
I'm not gonna
also
lie, gold is
delayed
setting
for
up
another year, imposing high
right
capital
now
rules
for the buy
on
position.
countries' banks
So
at
please
the
be aware
risk
at this
of
imbalance.
making
We've got an
them
alert here
uncompetitive.
for
And
gold.
the Swiss National Bank is highly unlikely now
We
to
do want to see
adopt
it do
a
something
proposed
similar
15%
to GU.
capital requirement
GU this morning
for
when we woke up,
UPS and other Swiss banks. And
this
the
is
Bank
more
of
of what it
England
looked like.
has issued a near final proposal
didn't really
to
give
increase UK
a
bank
harsh dip
capital
down,
by 3%.
but the small dip down was enough
And I
to
think
carry us
this
through these
is
highs
all a
here.
measure of your great work and that of your
As you guys
vice
can see,
chair.
I really wanted
And
us
I
to get
just
that.
wanted to
But gold is
let
probably
you
going to be a
have
pair that we can catch
comment
entries
on
on
that, please.
Sure. So
at
we're
around
committed
this
to
imbalance level
finalizing
that
this
I am
proposal.
looking at.
Our banks are going to live with these rules for a long, long time. The main thing is to get it right, and that's what we're
So
doing.
let's pay attention. I will
what
be
we
taking
do
that
in
with
the
you
end
guys.
will be consistent with the Basel
Yes, oil is
agreement,
moving
and it will also
perfectly.
be consistent with what other comparable large jurisdictions are doing.
You're doing a great job. Keep up the good work.
We'll recognize the gentleman
That's
from
lit.
Pennsylvania, Mr. Muser, for 5 minutes.
Thank you very much, Mr. Chairman. Thank you very much, Chairman Powell, and also thank you for continuing to indicate that you will look at
So
the
we did play
entirety
off
of
that
the
imbalance
whole
there.
economy.
I see.
Appreciate that. All right, so one of the nation's largest
That
banks
was
recently
lit.
warned in
I'm not
a
gonna
memo,
lie, I didn't
and
snipe
it's
it.
also been voiced by smaller banks that the current pace
Didn't
of
snipe
regulation,
it,
such as
but
changes to capital requirements and lowering debit card interchange
get
gaps,
back that
could lead
chart
to new fees
you had
associated
up. So this is the chart.
associated with checking accounts and other
had at the
increased costs for
imbalance.
small businesses. This does come
It
amid
actually wicked
expiring
at
tax
around
provisions
9,
that are
9:30.
sunsetting as we speak, that are critical for small business. such as the R&D tax
The
credit,
15-minute
interest
did give a
deductibility,
cleaner
and bonus depreciation.
stab. Once I
This
saw the
does raise the
15-minute
question,
candle
are you
close
considering how these
bullish
regulations
like
and
that,
tax increases will
I
directly
realized
work
that,
against your mandate to achieve 2%
you know what,
inflation? Moreover, with the proposed
this is
changes
going
to
to go
Basel
up.
III,
Because the
it is crucial
30-minute
to ensure that
candle
all
closing on
stakeholders have
higher
a voice in
volume
this
here,
process, which you
you know,
are
actually
stating
went
will
ahead
occur. And a
and
Basel
continued
III
up
proposal and
towards the
adequate comment
upside. So
period are
if
certainly
you're in oil,
very
you know, just
welcome.
continue to hold on
So,
and let
Chairman
it
Powell,
rock.
yesterday in the Senate, you mentioned that the majority view of the board is to repropose Basel III for comment period. Could you clarify if this means the proposal will be reproposed from scratch, and any other specifics you can provide?
Sure. So we haven't reached agreement on this. As I mentioned, we're working through this with our colleagues at the FDIC and the OCC. And I can't tell you exactly what the form of it would be. The sense of it would be, though, that we're making material changes and that we would want the public to have a chance to look at those changes in the light of the way they play off against the quantitative impact survey and should have a reasonable time to comment on those. In addition, we're focused on one big area, but there are institutions that have made comments all across the spectrum, and we're reading all of those carefully. And we're not going to republish all of those. Some of those we can just make changes and move forward on. So it's going to be a very labor-intensive, time-consuming process.
Okay.
Writing these things up takes
get
a long
back.
time, and we're going to get it right.
Good, that's great. Obviously, Canada recently postponed, as did the EU and UK,
Gold is
for
ranging to me.
international
Yeah, it is.
competition standpoint.
It definitely is.
It seems to make sense, and so that's appreciated. Chairman, would you agree that excessive spending, increased taxes, limits on domestic energy production, in principle, are a cause for higher costs for business, contributes to inflation?
So I'm watching this,
and
I'm
as
just
well
really
tightens the
analyzing
labor
the questions
markets,
that
kind
they're
of running
asking
contrary to your two mandates?
to Jerome Powell.
You're asking
listen
me
up.
kind of a political question there. I don't want to criticize a platform of economic fiscal policies that are not really ours to decide.
It's more of an economic question, but I appreciate your answer, sir. So when you mentioned recalibrate policy yesterday in the Senate hearing, was part of your thinking taking a more holistic view of economic conditions?
Yes, very much so.
Okay.
Yeah.
Okay. Chairman, is there any data to support the so-called greedflation? This term greedflation somehow has caused inflation. Is there any data to support those comments?
So we look at it that this inflation has been caused by a combination of very strong demand and constrained supply. So it was really a high-speed collision between an economy that was reopening, and by the way, there was inflation all over the world at the same time. So these are some common factors. But at the same time, you had tremendous demand, for example, for automobiles. You had constrained supply because there weren't enough semiconductors. Long story short, but so that to us is what this inflation is all about. So we've observed, the sort of healing of the supply side at the same time. Restrictive monetary policies weighing on demand, and we've seen inflation coming down from those.
So there's no data that supports that gouging of consumers is part of the inflation.
It's been very hard to track a connection with earnings and things.
Secretary Yellen mentioned that she didn't feel that there was grocery price shock and that sort of thing. Groceries and gasoline are the two driving problems for American families and certainly my constituents. Do you believe your policies are helping to alleviate in those two areas?
So a lot of things affect, let's take energy first. The energy prices are generally set at the global level. We do have some effect on that.
Sorry,
but not
Chairman,
that
I've run
much.
out of time. Thank you. I yield back, Mr.
Sorry,
Chairman.
we can continue.
Great, thanks.
The gentleman from Missouri, Mr. Cleaver, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Mr. Chairman, for being here. In some ways, I want to follow up or at least respond to the very civil, but I think reason of why we need an independent central bank. And your response was, the question you raised would, if I answered it, it would be along some kind of a political avenue, and you didn't want to drive on that avenue. So I'm also very much concerned about a lot of the discussion. I've been on this committee a while, and so it comes up quite often. When the Federal Reserve was birthed around the turn of the century, I think, around 1913, 1918, somewhere like that, prior to the establishment of the central bank, was our country experiencing a lot of recessions because of no security? People felt no security, particularly the business community, in making big investments because nobody was in control. Just kind of think what went on just went on. Is that relevant?
Yes, I think the lack of a central bank between 1836 and the founding of the Fed was a period of lots and lots of depressions, and a lot of it had to do with the crop cycle and the banks not being able to handle the very large seasonal swings, and there was no central bank to provide liquidity. So that's really what gave rise to the founding of the Fed in the early part of the last century.
Do you think that it is dangerous to blend monetary policy and fiscal policy?
To blend them?
Yes.
So we try to keep them very separate, and we try not to express views on fiscal policy that's for elected people who have undergone elections and won and make those very difficult decisions. We have a really specific, narrow but important mandate that you've given us, and we try to stick to that. And so we take your policies as given, and then we conduct monetary policy with that.
I don't want to draw you into any kind of a political response, but and I have not read all of this Project 2025 document. I read some of it online a couple of nights ago, but even whether it comes out of a 2025 or a 3089, whatever, one of the things that I'm concerned about, reading this from this document, that the document argues that the Federal Reserve is the inflation problem, and eliminating the Federal Reserve, imposing economic policy on the Fed that does not come from within the Fed. So I'm wondering here, would you agree with any of that I just stated, whether it came from me or Chairman McHenry or anybody else?
So I'll just say, first of all, we're certainly fair game for any criticism people have. I think what we've learned and what we know is that having an independent central bank is really essential. If you want to have high and volatile inflation, then the quickest road to that would be to undermine the independence of the central bank, of the Fed in our case. So I frankly think that view is very widely held. I find up here on Capitol Hill in both political parties.
So eliminating the Federal Reserve is best for promoting economic stability.
Yes.
Thank you. I knew that the ranking member was going to come in and deal with the issue of housing. She always does, and we all appreciate the fact that she's obsessed with it, and I like that obsession. But I'm wondering, as we try to figure out how to deal with this issue. Oh my goodness, my time's running out.
Was that a question?
I didn't finish it, but yes. If you knew where I was going, please.
Gentleman's time's expired. We'll now recognize the gentleman from New York, Mr. Garbarino.
Thank you, Chairman. Chair Powell, thank you very much for being here today. Based on some comments made today and yesterday, it appears you've made quite a bit of progress on changes to the Basel III Endgame proposal, and you're very close to agreeing some of the substance of those changes. I know you won't get into specifics, you said that. I just don't know how deep you won't get into them, but I just want to confirm what you said to my colleague, Mr. Music. There will be, you're not reproposing some things, it's just going to be a partial reproposal?
That's what we're looking at doing, is major things that we've been working on. And there will be additional changes that will be made that won't be reproposed. That's what we're working on, rather than a full wide proposal.
So it's not a complete reproposal, just partial?
Yeah.
Can you get at least into, can you tell me which components you're?
You know, it's not until it's all agreed and ready to go and vetted. I'm reluctant to try to get into too many specifics, just because, you know, when you're doing these things, nothing is agreed until everything's agreed.
No, I understand. I'm not asking for what specifically your changes,
Yeah.
which, if you're willing to say which.
I hope to be able to come
Okay.
to you with a really clear answer on that soon. I mean, I think we're ready to go at the Fed.
So that's my next question. So it's been said several times that you and many of your members of the board are at odds with your counterparts at the FDIC and OCC over how to proceed with putting out a revised proposal for comment. So if the FDIC and the OCC are not yet on board with allowing for a new comment period, who is holding up this consensus? Is it Chair Grunberg? Is it Director Chopra?
I don't want to say that we're at odds. I just want to say we're working through this issue together.
Someone's got to be holding it up.
Well, you know, it's a discussion that we're having, and I think it's been constructive, and I think we'll try to keep it that way.
Can you at least answer whether or not the 5-member FDIC board needs to sign off, or can you just go to the chair?
No, I think it's the board, and of course the comptroller is one person, but I think I mean, the FDIC can speak for themselves, but I do think their board would be the question.
Okay. One final question, on timeline question before I move on. You mentioned yesterday that a reasonable prediction would be that Basel would not be finalized until the first quarter of 2025. Under this timeline, would it be safe to say that implementation would then not occur until at least the beginning of 2026?
Again, I can't be that specific. And, you know, someone asked me, does it sound like the first quarter of next year might be? And I said, it might be. I mean, there's a range of times it would take. The thing is, as I mentioned, U.S. banks are going to be living with these rules for many years. The point of it is to get it right.
I do like gold here.
Quickly. You know, we want to
not
get it
gonna
right,
lie.
listen to the comments, make
It
sound
looks really
decisions, and move ahead.
I do want to execute
that is, you know, gives us a sustainable set of rules that we won't have to come back and
so
fix.
let's see how this 5-minute candle plays out.
Thank you. I want to move on to another topic, long-term debt. You mentioned yesterday that you would most likely not move forward with other rules until
Let me
people
know
reach a place
you
of
guys like
understanding and
gold
acceptance
buys.
of a revised Basel proposal.
Honestly,
I
it
hope that's
looks
the truth,
in a
as
good
banks need
position,
to
but
fully understand the implications.
not gonna
of
lie,
the Basel
I just want to
proposal
see a
before
small
any
reaction.
action is
and
taken
looks
on
good to
long-term
go.
debt. Finally, Chair Powell, I'd like to emphasize the need for the Fed to conduct a comprehensive, data-driven, and most importantly, transparent assessment of the current liquidity framework. So very quickly, will you commit to conducting a public quantitative impact study and a full notice and comment rulemaking before imposing any new liquidity requirements?
I didn't catch the first part of that. The first part of your ask.
Will you commit to conducting a public quantitative impact study and a full notice and comment rulemaking before imposing any new liquidity
On the liquidity thing, I'm not exactly sure what we're contemplating there. We certainly contemplate getting a full range of input from the public on that, because some of these are novel ideas, and we understand that.
All right, as the chairman said before, these impact studies are very important because they're to show what impact these rules will have. So I think that is very important that we have that, because we had a mucked up process with Basel 2.0, and I don't think we don't want to repeat that. And I have a little time left. I'm going to yield to my colleague from Pennsylvania, Mr. Music, because I know he had another question.
I thank my colleague. Chairman Powell, just back to what we were talking about, the price instability of groceries and gasoline, where we do have somewhat of an affordability crisis, has been termed. So would lowering rates in the near future be a pro-growth initiative, perhaps? Is that something that's being considered that would actually drive investment and give a clearer picture for investment and perhaps help in these two categories and, in the end, increase in supply so as we lower those prices?
So, honestly, when we think about our near-term rate moves, we're thinking about a couple things, and the first of which is we want to be more confident about inflation.
My apologies, Chairman, I went over.
Sorry.
Chairman, I yield back. I yield back to my colleague.
The gentleman from California, Mr. Vargas, is recognized for 5 minutes.
Thank you very much, Mr. Chairman. Thank you again for this hearing, and the ranking member, thank you very much. Chairman Powell, thank you very much for being here. We appreciate it. In fact, I was looking at your history when they were saying who nominated you when you got here and all that. In fact, you had public service even prior to that time, right?
That's right.
So I thank you for your long public service to the nation. I think
Thank
you've
you.
been outstanding. I think
Appreciate
we all
it.
respect you deeply here.
Guys,
Pretty
gold looks
boring
good
here
here.
today,
If you're not
Jeff.
already in, I
Sorry?
hope you guys are
You're
in.
pretty boring here, to be
Sorry, I'm
frank.
on
Thank
another
you.
call. I'll be
That's
right
a-
back.
That's a high compliment.
Yes, it is, because sometimes when you're here, there's all sorts of cameras here, and they're watching your every step and all. And I think there's a reason for that, right? And that's because the economy's doing all right. Am I wrong about that?
You know, take a look at our economy. We're growing at around 2%, it feels like. Inflation is down to 2.6%. Unemployment's at 4.1. These are good numbers.
Yeah, I mean, I hear the parade of horribles on the other side, how the sky's falling, but I don't see the media here to attest to that. In fact, it's just the opposite. Did you read some of the headlines of the new government in Britain? Some of the headlines? If not, let me read one. It says, "New British government inherits worst economic plight since World War II." And in fact, there's a number of headlines like that saying that England's in trouble. I imagine if you were running their central bank, I bet you there'd be a whole bunch of media here beating you up to find out, what the hell you're doing or what you aren't doing. And I think the reason for that, again, is I think the government here has done a pretty darn good job. One of the things you said you didn't see coming was the pandemic, right? I'm not putting words in your mouth.
Right.
In fact, I was here and I heard the parade of horribles that we were going to have a recession, maybe a depression. In fact, the country was going to fall apart. Did it?
No. We went through a period of high inflation as the other countries did. And, that's very challenging
And in
for
fact,
the people.
isn't it the case that most of those countries had higher inflation than we did in Europe?
Over time, there were times when their inflation was higher. I think
Yeah, it was.
overall it was broadly comparable.
Yeah, in fact, I brought it up a number of times here because there was a whole bunch of those countries that had much higher inflation than we did.
Well, Europe was much harder hit with the energy issues coming out of the Ukraine war than we were.
Sure. I mean, there's a whole bunch of other issues to instability. They had political instability and a whole bunch of other things, obviously. But, I mean, it is interesting today that, the parade of horribles that we hear doesn't seem to manifest itself with the media or the attention that you normally get. And that's good. I mean, I think that's a great thing. Now, I do want to ask a couple questions. I do have concerns, Basel III on housing. I think I've made those concerns known to your office, and I won't rehash them. But I do have issues that I want to talk to you about with regard to climate. Obviously, you said you don't read too much of the news. You didn't hear about Project 25. I don't think that's what you meant to say, and I don't want to put words in your mouth. I think when the ranking member asked you if you had heard about it, I think you said no. I think you've probably heard about it, but you haven't read it.
I've seen nothing more than headlines on it. I mean, I've devoted zero.
Yeah, me too. I don't read
energy
that.
into.
Yeah, I don't read that wacky stuff myself either, but I certainly read the headlines. But the reason I ask about the headlines is that you obviously have seen what has happened in Texas. You've seen what has happened with climate change. And in
Yeah,
fact,
guys,
you testified at things
honestly,
before that you
gold
believe
is
in
pretty
climate
range bound today. I'm not going to lie. This is an optional
Yeah.
trade.
And so what are we doing?
It is
We've
already
taken a
11
number of
o'clock,
steps. I think they've been very
so
positive to make sure that we
It's
look
probably
at the risks
going to
of climate
just
change.
chop
Could you go over
around
some of
here.
those? 'Cause
Don't
that
take a
does
loss
concern
on
me. I
this
think that's a
trade for
change
sure.
that we also
So if you're not
didn't
already
see.
in,
Well, we saw. I saw.
don't,
I've been saying it for a long time, but a lot of
pipe
people
in
didn't
or
believe.
anything. If
So
you got
we-
in,
if you're looking at
you
financial
were on the
regulators,
stream
you're
the
looking at
entire
people who have a
time.
very,
Or
very
we were looking
limited
at
role
gold, and you decided to get
in
into
climate,
gold.
and that is just to
I do believe it's
look
going
at
to
the
continue
institutions
up.
that we
I do
supervise
believe
and
that
make
this
sure
is
that they
gonna
understand
actually
and
rock
can manage
out.
the risks that they're running.
It's just
that
I don't
we
want
are
you
not
guys to
climate
try to
policymakers.
ape in.
Right,
That
and
is-
I'm not
it
asking
has to
that.
be
If
elected people
if
who
you
do that.
believe it,
Right,
it's,
but you have
it's
to
going
take a look at the
sound
risk.
you're,
I mean, look at the risks that
in
the insurance
in a
companies
spot
are
where
taking.
you don't want to actually
And the banks, of course,
at
are
11 here,
financing these homes,
then
and now you
by all
can't get
means,
insurance on them,
don't-
so all of a sudden you
don't
can't
force
rebuild. I
yourself.
mean, these are risks that
But
the
if
banks
you guys are in the trade,
are looking
So
at.
we don't
definitely
regulate
looks
insurance
good.
companies.
No,
Definitely
right,
looks like
but
it's
you
gonna continue
regulate the
rocking out
banks.
here.
Thanks. Yeah.
And these banks have mortgages on those houses, do they not?
My brother said up
Well, in
good
many
on
cases,
YM.
they're
What
not
are you
writing
up?
mortgages
You up on a
anymore.
buy?
So that's the result we're getting is that banks are saying, They see these risks. They do.
My time's up, but thank you again. Appreciate you.
Thank you.
The gentlelady from California, Mrs. Kim, is recognized for 5 minutes.
Thank you, Chairman. Chairman Powell, thank you for being with us today. Gosh, you're under a lot of pressure from all sides to divert from our monetary policy goals. And I commend you for your leadership and staying focused on the core missions of the Fed, which are price stability and maximum employment. So thanks again for your leadership. And you have stated that it is the Fed's strong view that you will have to reopen the Basel III Endgame proposal for comment again. And I really urge FDIC and OCC moving forward with reopening the comment period. Chairman Powell, would broad support mean abandonment of any modified proposal that garners mostly negative public comments in a public comment period for the modified proposal?
Sorry, I didn't follow your question.
Would broad support mean abandonment of any modified proposal that garners mostly negative public comments in a public comment period for the modified
these buys
proposal?
Are
broad
interesting.
support empirically would mean,
especially with,
a good solid vote on the Fed board. And I've
to
tried
see if
not to be
this
specific about
actually
what that
runs
means.
crazy.
It also means broad support among the broader community of commenters on all sides.
Looking for an entry myself.
That's what I meant by broad support.
This is a good retest.
Yeah, that's what I meant.
On this level.
Thank you. And as the Fed looks to enacting several changes to the proposal, I would also urge you not to overlook how the Basel Endgame proposal would disproportionately impact FBOs and regional banks and U.S. domestic jobs because of the way the outside operational risk is, weighted. So can we get your commitment to that?
So let me just say I'm not going to get into specifics. We're well aware of those concerns. We've obviously carefully digested all of the comments we've gotten from all different sectors, and those are concerns that we're well aware of.
Thank you. Let's switch gear to another matter. You have spoken for the need of transparency. Are there any conversations at the Fed to have more transparency and better engagement and consistency with stress tests?
I am looking for buys as well, but
we have
probably
increased
not quite
transparency
ready
in the
yet
stress
today,
tests
so
over
don't
time.
force it.
And I would say, we do,
above the high, so
if people want to write articles and make comments that are critical of the stress test, we're going to read those and we're going to think.
Yeah,
about
gold
that.
is going to
We're
stay
open
range
to
bound today.
improving it. We
Don't
know
really
that the stress test has to evolve over time if it's to remain relevant. And I think transparency is one of those subjects
let this thing
where
rock.
we're prepared
Don't take
to
a
listen
loss.
and think about
It's right back around entry.
Definitely.
So
I would like to see
got in,
a stress
probably
test
get out now
regime
and
that is more
not
transparent and
hold
adept
this
at
thing out.
identifying unforeseen risks.
Nas,
So we
I
can
believe we
achieve that
cleared
by
some
being
lows
more
here.
collaborative, I believe. Yes.
Once
So
we
I'm
clear
also
this.
interested to hear from you whether you and your fellow banking regulators have considered the cumulative impact of any new liquidity standards with the Basel III framework and
Then
the
we can
existing
send
post-crisis liquidity requirements. So what industry engagement has the board staff held with respect to
I
changes
do believe
to
we
the
are still
liquidity
going to send
framework?
higher here on gold. It's just
So we haven't actually made
Going
any
to
proposals on that yet.
Mm-hmm.
We have had significant industry
time.
interaction on the proposals, and we will move.
So
I think,
GU is
sometime
already
this
running,
year.
guys. That's
What
an
about
update.
the board
GU,
staff?
same with
Have
oil.
they conducted any industry-wide data
Gold
collection
looks like it's
to
getting ready to
study
run
the
right
necessity
now.
for and
up
the
to you
impact
guys.
of any changes to the
You
existing
want to get in this
liquidity
position. I
framework?
still do
I
believe
think
it's
we've
going to
done
buy out.
a lot of
Watch the 5-minute
investigation
candles.
on that
If you
front,
get a
but I think
5-minute
that
engulfing
this is the beginning of
candle,
the process, not the
That's
end.
also another really good confirmation.
We
that
haven't
I like
published
to look for.
proposals yet. We're working
with
on them. It's a
NAS.
pretty early stage.
I'm not going to enter any
Thank you. Let me
position here on
quickly
NAS.
talk about
or
the inflation
oil.
issue.
So,
We
with that being
had
said,
a peak inflation
that's
rate
all
of
for today.
9.1% in June 2022, and
Let's
a lot
continue
has
to
been
watch
talked about being a supply side issue and
for
the
about 5 more
demand
minutes and
shock
see
from the
if
opening
anything else
economy.
happens.
So can you elaborate how the expansion in the money supply and fiscal stimulus played a role in persistent inflation, and why is it so important to get to the 2% inflation rate goal right now?
So the inflation that arose here was a collision between very strong demand as the economy reopened. Remember that there had been fiscal transfers. We had rates very low. You know, those things were done because we thought we could be looking at a very, very bad economic time. As it turns out, the economy reopened and demand spiked very high. People had saved a lot of money because they couldn't spend. And so there was tremendous demand and there was constrained supply. And what you got was inflation. And you got that everywhere in the world. That's what happened. So what's happened to bring inflation down, we've made quite a lot of progress on inflation. To bring inflation down, the Fed has been working on, with restrictive policy, on cooling demand. That has been working. And the supply side has been healing. And the negative labor participation shock has essentially reversed, adjusted for. So it's kind of working out as we had expected.
Thank you very much, Chairman.
The gentlewoman from Georgia, Mrs. Williams, is now recognized for 5 minutes.
Thank you, Chairman McHenry, and thank you, Chair Powell, for joining us today. As the president of the Federal Reserve Bank of Atlanta, Raphael Bostic has so rightly pointed out that combating economic inequality is a critical part of the Fed's dual mandate. When everyone in our community doesn't have the opportunity to contribute to their fullest potential, the economy is not firing on all cylinders. Nowhere is this more apparent than in my home city of Atlanta, which has more Black-owned businesses than any other city in the country, but is still among our nation's leaders in the racial wealth gap. I applaud you and your staff at the Federal Reserve for the work that you're doing to make sure that the economy works as well for the hardworking people of Georgia's fighting 5th District as it does for those in the top 1%. This includes helping to make sure that financial services are affordable and accessible to everyone. As the Fed moves forward with the proposed changes to Regulation 2, I know that protecting access to affordable and accessible banking is at the top of your mind. That is why I was concerned when I started receiving outreach about the unintentional effects that Reg 2 proposed rule would have on marginalized communities, including my constituents in Atlanta. Specifically, I heard about the impact that the reduction in interchange fees proposed by this rule could have on bank-owned certified accounts in my district and across the country. The Bank-Owned Initiative is a partnership between financial institutions and trusted community-based organizations to offer low or no-cost bank accounts to unbanked and underbanked individuals. Access and affordability are at the heart of the changes that you're proposing, and I couldn't agree more with those goals. But we have to make sure that programs designed to serve unbanked and underbanked individuals in marginalized communities continue to flourish. In response to these concerns, my colleague across the aisle, Mr. Lukemeyer, and I sent a bipartisan comment letter in March to you highlighting those very concerns and urging that the final rule not negatively impact low and moderate income communities. Chair Powell, how does the Fed take into account how regulations impact constituents who don't have an attorney or an interest group to submit a comment on their behalf?
Well, let me say first, we have heard those concerns that you raised and others have raised about aspects of the proposed rule, and we very much understand the concerns that are being raised. In terms of people where we don't have comment letters, we try to be thoughtful about the impact of our regulations, but principally we're looking for public comment on things.
Thank you. The FDIC's most recent data shows that the rate of unbanked households is at an all-time low. The Bank-Owned Initiative has certainly played an important role in this progress. Bank-owned certified accounts are available to more than 95% of low and moderate income households across all 50 states. Access to low or no-cost banking services is a door to financial inclusion and wealth generation for marginalized families. As written, Reg 2 could undo some of the enormous progress made in the past several years. Chair Powell, how can regulators work with members of this committee to ensure that future proposed rules do not hinder Americans' access to tools that enhance the Federal Reserve's financial inclusion efforts?
So we're very focused on things like bank-owned, as you pointed out, and on access to the financial system for marginalized communities. So we wouldn't want to do anything to weigh on that. We were happy to work with you in your office on those issues. But as I mentioned, we're hearing the comments and we're reading them and we're we're taking those into account as we think about appropriate changes to the proposal.
Yeah.
So we
I'm
will
listening
definitely
to this.
follow up on that, because as we're writing these regulations, I want to
She's
make sure
grilling
that,
him.
that we're thinking about the real world impact and what it means to consumers when they're accessing financial institutions. I look forward to working with you to further the Fed's financial inclusion efforts. Like earlier this week, I sent you another bipartisan letter related to the Federal Reserve's April proposal to extend the operating hours of FedWire Fund Service to 22 hours per day, 7 days per week, and every day of the year. That was news that I was eager to hear. This may sound like a small technical change, but it can have a big impact on our constituents, especially for those living in marginalized communities who live paycheck to paycheck. Growing up in the booming metropolis of Smith Station, Alabama, probably never heard of it, Chair Powell. But there are limited options for loans and short-term loans. In an area where everyone needs a car to get to work and they have to work to eat, when money is short, any delay in accessing a paycheck or paying a bill can disrupt your entire household. Extending operating hours for FedWire Fund Service and National Settlement Service will allow people continual access to their funds outside of what we've deemed normal operating hours. And I hear the gavel. I'm out of time, but we will be following up for more conversation. Thank you.
Thank you.
The gentleman from Nebraska, Mr. Flood, is recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, after a year with very high inflation that battered American paychecks, inflation rates have moderated some. However, inflation continues to linger above the 2% target rate set by the Federal Reserve. In fact, the PCE inflation index has remained above 2% for the last 3 years. The Federal Open Market Committee's statement on longer-run goals and monetary policy strategy issued at the beginning of the year stated, and I quote, "The committee seeks to achieve inflation that averages 2% over time and therefore judges that following periods when inflation has been running persistently below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2%.
NASDAQ is reacting off of that level really nice that
Chairman
I have
Powell,
marked up.
Does
for
the
a 5-minute
commitment to achieve a
Not
2%
sure if
average
anybody's
over
paying
time
attention to
apply
that.
in the other direction as well? Meaning
I
that
like
if
gold
inflation
to
remains
still
above 2%
continue
for
to
a
react here.
protracted period, would the committee instead aim for inflation moderately below 2% for some time in order to achieve an inflation average of 2%?
No, it doesn't.
Is it fair to say that you would need to see the PCE index dip below 2% at least once in the coming months in order to contemplate a rate
All right,
cut?
guys, I really don't think I'm going to
That's not
take
fair to say. We've
any
said that
positions here.
you don't want to
Gold is
wait
moving
until
slow,
inflation gets all the way
and
down to
NASDAQ
2%, because
slowly just
inflation has a certain
like down,
momentum.
so
You wouldn't.
it would
wait that
probably be
long.
a good day
If you
to
waited
stay
that
out
long,
the
you probably
markets
waited too
unless
long, because
you're
inflation
really
will be
itching for
moving
something.
downward and will go well below 2%,
But
which we don't want.
with that being
What
said, I will
combination
drop the
factors
link
would you need to see in order to support a rate
to
cut
this actual
month
live.
or in September?
You guys want to continue
So,
watching?
I'm once again, I'll say.
Did
I'm not
anybody
sending
catch any trades
signals
today?
on any
Drop a
particular
one in the
date of
chat
any meeting
if
whatsoever
you're
on
in
policy. I
any
said that
positions.
yesterday, and I'm saying it again today, but I will answer
Drop
your
a
question.
two.
So what we said
If
is
you
that
didn't
we
take
want to be
anything.
more confident. We want to
didn't
have
take
greater
anything.
confidence, and that means
That was
more
me
good
today. I
inflation
actually
readings.
decided to
That
not really
inflation
take much.
is moving sustainably down
We will wait.
to 2%. Greater confidence.
There was
that
some
that is the case.
opportunity
Remember, we have a dual mandate too. We're not
on
just
the
an
actual
inflation targeting central bank.
oils.
We also have an
Oils
employment
are
mandate.
by
So
opportunity today.
I could also see us
Shout out
cutting,
to
and we've
Safe.
said this, I've said this, if we
Shout
saw
out to
unexpected
Andrew,
weakening in the
my
labor
guy
market.
Drew.
And we do now
Appreciate
see,
you, bro.
I'll say speak
I'm gonna
for
drop the
myself.
link to this
I now see
in the chat, and if
the
you guys have any
risks of
questions,
the two
comments, or
mandates as
concerns,
much closer to being in balance.
feel free to
I
reach
think
me in the
for
Discord.
A long time,
you guys
we
are
had
not
to
in
focus
Discord.
heavily on the
Go
inflation
ahead and
mandate. But I
join
think now we're getting to the place
in the
where
description.
you're,
Go ahead and drop the link as well.
The labor market is
In
getting pretty
YM
much
still,
in
how's it
balance to
going?
where it needs to be, and so we're looking at both sides.
I know that the media and others have continued
Good.
to talk about
Now
the
it's time
prospect
to
of political
go break
interference
even on
with
this
the Federal
trade.
Reserve. With an election
Take a
coming
little
up, I know
partial.
you are very aware of the heightened
Ride out for
scrutiny
the rest of
awaiting
the day, bro.
the Open
Good-
Market
good-
Committee
good-
meetings
good
in
stuff,
July
man.
and September.
Good
Can you
position
use this
there.
opportunity to speak regarding the Federal Reserve's political independence going into this election?
Sure, I'd be glad to. So, our political independence is critical to our ability to do our jobs and to sustain the faith of people across the political spectrum. And it comes down to we make our decisions based on economic data, the evolving outlook.
So with that being said,
balance of
guys,
risks.
I appreciate
Don't
each and
take
every
into
single one of you
consideration
guys.
any other factors.
Hope you guys
including
have a blessed
political
day.
factors.
Already break even.
We have a long history
Let's get it.
of doing that, and I think the public believes we will do that. Any decision that we make to, on rates.
Appreciate you guys once
on
again.
any of our policy tools, it's
And
going to
yo,
be very well
you
grounded.
guys are having a blessed day. Go ahead and drop a 333 in the chat. Everybody should be having a blessed day. Let's have
To get started in data analytics, you don't need previous experience or a degree. The Google Data Analytics
Hit me up. See you at the top. As you guys already know. The bottom is way too crowded. Let's get it.